Learn to Earn by Peter Lynch. So this book starts off by talking about how schools do not teach you the proper tools you need when it comes to investing. And that what you should do is take your savings and start investing that money and to start as young as possible. He then goes over how saving is extremely important and that most companies are actually publicly owned and that the idea of being greedy by wanting to make more money is actually a bad thing and that you should want to make more money to provide a better life for yourself. He then goes over what a stockholder is and how you have rights to the company, like your voting rights, and what a dividend is and how it's basically a payment to you from the company's profits. And that the best thing to do is to hold on to your best stocks forever and ever and to not panic sell when things start to go bad. On why this strategy is better than trying to time the market as well. That it's almost impossible to time the market and that more often than not you'll miss out on the big rallies trying to do so. The money you should invest with is money that you can set aside forever and never have to touch. And that the beauty of the market is that sometimes they'll have these magical, unpredictable stretches where the market just seems to keep running up more and more. He then explains what mutual funds are and how they could be an investment opportunity for you and how dollar cost averaging can make you the best investor by using this strategy to always take your money that you're saving each and every month and rebuying the shares that you currently own that are good stocks and good winners. He then explains the power of dividend reinvestment and how it can greatly grow your portfolio, and then explains the fees associated with mutual funds and outlines the worries about brokers because they have agendas and they're trying to sell you stocks that you may or may not want to own. He then explains how stocks always outperform bonds, or at least 9 times out of 10 will, and that if you really are trying to invest in a mutual fund, you might as well go with the long-lasting funds than the ones that are just starting out. And that if you really want to look more into this, to go to Morningstar and look out for the best funds on there. He then outlines the risks when installing your investment plan to buy smaller companies and how they can be your big winners or they can also be your big losers. And then he explains what an index fund is, what the S&P 500 is, and what the Russell 2000 is. And how when you first start trading, you should do paper trading, and that the worst forms of strategy are random picking, tip picking, educated tips, broker picking, and that at the very least, you should be doing your own research. What he means by random picking is picking random stocks. Tip picking, he means by picking stocks from your friends and family that are suggesting so. Educated tips are the ones that come from the professionals on either TV or in the newspaper articles. And broker picking is exactly what it sounds like, picking stocks that your broker is telling you to buy. He then explains that when you're doing your own research, you need to know the company. You need to know what their sales are like, how much debt they have, what their future earnings should be, if they've been increasing their dividends every year and what their current dividend is at compared to their previous years, and that if the stock is trading at a bargain or if it's overbought or oversold. He does warn you, however, that educated guesses can't always predict the future, and that actually some of the best ways to get stock if you're younger and you don't have a lot of money is to ask your family to buy you stocks instead of to buying you gifts. He then goes over some of the major exchanges like the New York Stock Exchange and the NASDAQ and what it is to buy stocks on market versus limit orders and how the PE ratio is a great way to tell if a stock is overvalued or not and explains the concept behind the PE ratio. Later, he goes over your rights as a shareholder and some of the cool benefits that you get and how it's illegal to hide the truth in a publicly traded company. So all those forms with balanced income statements and things like that, they cannot lie on there or else it's fraud. And how a great cool thing to know and keep in mind is that the earnings of a company directly affect the stock price. It may not reflect it currently or with even a few months, but over a long period of time, the stock will have to adjust to the correct price based on their earnings. He then gives the example of the Lambo and how to tell if a stock is expensive or cheap, and how if you were able to get a Lambo for like $70,000, even though it's worth $150,000, that's a good deal for a Lambo, even though it might be expensive to most people. And it's the same thing with stocks. Even though a stock might be trading at $150 a share, but it's worth $200, it's on sale, even though some people might be thinking that it's too expensive or overbought, even though it's actually on sale. It's just that they can't afford $150 per share. He then gives you a reference that if the market multiple is between 10 and 20, that the market's kind of at a normal fluctuating price, but if it's under $10, then the market is generally at a cheaper rate, and if it's over $20, that the market is really, really expensive, and that it's very bad to judge a stock on a price while you own it. Meaning if you see your stock and you bought it at $50 a share and it's now trading at 45 and you're like, oh, the company's doing really, really bad because the stock's at 45, that simply probably isn't true. Just because the stock is going down doesn't mean they're doing horrible, and just because the stock is going up doesn't mean they're doing great. He then gives the example example of Nike on how they had 20 straight quarters where they kept making more and more money, yet the stock was going down, and how sooner or later a correction came and the stock almost tripled overnight, and vice versa. He also gave the Johnson & Johnson example on how the whole health sector as a whole was crashing down, but if you really looked at the news for Johnson & Johnson, the reason the health sector was crashing wasn't going to affect them at all, but because people got scared, they're all selling their stocks just because it was in the same sector, making Johnson & Johnson vastly undervalued. And when the correction came, over a span of 18 months, the stock went from about $40 a share to over $85. He then leaves you off with a few good notes that you should not try to time the market, that is almost impossible, and that you need to hold stocks through thick and thin. So I hope you guys liked the book summary. I really enjoyed this book. It gave some cool insight to certain areas. It was really a beginner book and that's not a bad thing. It's a great thing. It's a great introductory book. It doesn't really explain a lot, but it tells you the hopes and benefits of investing in stocks and some things you might do when you first start out, like the 5 kind of worst trading tactics, just to keep you in mind. So either way, I hope you guys really enjoyed the book summary. I love doing these. Leave a comment in the comment section below if you guys want to see any future book summaries. As always, remember to leave a like, comment, and subscribe for more future content. Thanks for watching.